Good afternoon and welcome to our webinar today. I'm Sophie Lewis. I'm the Senior Marketing Executive at Equiteq, and today Ramone Param will be discussing the M&A trends and insights from our latest report. We're going to do a couple of questions at the end, so if you have any questions, please post them using the control panel. You'll find it at the bottom on the right-hand side of your screen. Over to you, Ramone.
Great, thanks, Sophie. So before we start the presentation, I just wanted to give you a little bit of background on myself. My name is Ramone Param. I'm a director in the market intelligence team based in Equiteq's New York office. Before joining Equiteq, I started my career with Macquarie Group's corporate finance business based in London. And I also worked with PwC's corporate finance business, where I was one of the initial members of the firm's global corporate development team, advising PwC's global leadership team on inorganic growth strategies, really focused around professional services M&A, including transformational deals like Booz & Co., now known as Strategy and a variety of smaller territory-focused deals across the professional services space. Some background on Equiteq's M&A report for those of you that are new to reading it. Our global M&A report is a focused review on M&A and equity market trends related to knowledge-intensive services firms across our 5 segments of the market. And that includes management consulting, technology services, media agencies, human resources, and engineering consulting. The report utilizes various subscription data sources combined with our own proprietary data sets on deals and valuations that aren't available anywhere else in the market. The webinar will discuss the key findings from the report, including an overview of M&A activity, typical deal sizes, regional variations, equity market trends, valuations, and buyer developments before wrapping up after about 30 to 40 minutes for some Q&A. Now, as a firm, Equiteq has been advising owners of businesses operating within knowledge-intensive services for 15 years on growth and how owners can maximize the value of their business upon sale. This year marks the first year that we transition the definition of our broader industry coverage from consulting to the knowledge economy. Over the last few years, we've seen the traditional consulting industry undergo huge amounts of change from technology-enabled innovation, particularly that which is being underpinned by artificial intelligence and the use of advanced analytics tools to deliver insights for businesses from the now large amounts of big data that they have available to them. And that's changing the industry from both the perspective of how a traditional consulting company delivers their services and also what services they're offering. So from a delivery model perspective, we're seeing traditional consulting companies increasingly enhancing their offering with advanced cloud-based tools and data analytics solutions. And from a service perspective, increasingly offering advice on digital transformation initiatives from strategy all the way through to implementation. And that means that consulting businesses are demanding new skills, a blend of creative entrepreneurial skills with a good knowledge of the latest technological advancements. And that means, we're seeing a lot of M&A partnerships, organic investment, which is all blurring the boundaries between different traditional consulting sectors, and also adjacent industries like software and managed services. And therefore, the industry is moving away from just using the term consulting, to capture, to truly capture the broader set of services that they're now offering, which are technology enabled. And that was clear from the emergence of digital brands from the likes of McKinsey and Deloitte, and also recently rebranding initiatives from the likes of Huron, who dropped the word consulting from their logo, all reflecting a rapidly changing industry, and why Equiteq's now transitioned our own definition of the overall market, covering our 5 segments from consulting to the knowledge economy. So with that industry background, let's dive in and take a look at the findings of this year's report. So 2017 saw a dip in the number of completed deals across the industry. Volumes declined by 5%, but buyers appeared to be more focused on larger transactions, as seen by average deal values rising by 5% over the year. I recently spoke with a corporate development lead at a large professional services network, and he was telling me how, previously they were looking at businesses that are, $10 million in revenue or even less over the last few years. But now the emphasis for their business is on, deals that are at least $20 to $30 million in revenue, and that are really going to move the needle for their organization. And I think that message, of focusing on transformational deals really does resonate with a lot of serial buyers that we are currently speaking with. That focus on bigger ticket transactions is now becoming more apparent. So the overall market, is robust, and particularly for larger deals. And the drivers for that are, a solid global economic outlook across most developed economies, an abundance of capital amongst strategic and private equity buyers, and that industry convergence that I discussed earlier, led by, the rapid transformation of industries from new digital technologies, which is really widening the pool of buyers for assets within the disruption zone of the market. And as we can see from the right-hand side of the slide, this strong investor confidence amongst buyers is also being observed from large increases in share prices and quoted valuation metrics of listed players. And we're going to discuss that and its implications a bit later in the presentation. Now that's deal activity across the knowledge economy, but it belies a lot of variations by segment and region. So firstly, let's look at the segmental variations. The strongest activity across the industry occurred within the management consulting segment, where we saw a 5% growth in deal volume. And there's a lot of different factors that are underpinning that trend. Firstly, political changes in Europe with Brexit, negotiations, the recent changes to the administration in the US, and the regulatory and political changes that are coming out of that. That's creating demands for various consulting services, particularly around regulatory advice and organizational redesign. Businesses, are also being disrupted by new digital technologies like AI, and are calling on management consultants that have strong digital strategy capabilities to help them navigate this disruption to their industry. And the digital technologies that we're really seeing a particularly strong demand for amongst management consultants are around AI and RPA. That's really at the forefront of a new digital era. We also saw particularly strong demand for sector vertical capabilities in management consulting, and possibly also in technology services related to serving healthcare and financial services clients. And we will be running a detailed review of the broad trends impacting consulting services to healthcare with a report and webinar over the summer, and you'll be able to find that on Equiteq Edge if you're interested in learning more about that particular space. Now, in addition to the management consulting segment, you can also see that there was also growth in the media agencies space. That increased, deal flow increased slightly by 1% over the year. And as we can see by the comparative size of the bubbles, but the bubble here for media agencies is a lot bigger, really reflecting the premium for valuations, revenue multiples in that segment versus other segments of the knowledge economy. And what we're being told by buyers in the media space when they're looking at digital media capabilities, and I think this resonates with a lot of other hot areas within the knowledge economy, is that the right talent and the right M&A opportunities are really hard to find, and that's driving up spaces in hot niches like digital media. Now, in contrast to what we saw in management consulting and media, there was a fall in deal flow with respect to IT services. Now, we attribute a lot of that to falls in demand for consulting around legacy systems, but cloud services M&A did remain robust. So it accounted for over 20% of all technology services deals in 2017, which was broadly in line with the proportion of deals, the proportion of technology services deals in 2016, which indicates that growth in cloud services M&A is really maturing. In contrast, we did see an increase in demand for data scientists and cybersecurity professionals, another space where we're being told talent is really hard to find, and also the right M&A opportunities is in short supply. The continued growth of cloud and connected IoT devices is expanding big data that's available to businesses. And as artificial intelligence is advancing, the development of more advanced analytical tools that can convert all this data that's around there into actionable data sets really means that M&A in areas like data analytics, AI, cybersecurity is really growing, and we're seeing that as bucking the trend for the declines that we're seeing in the overall technology services sector. Now, moving on from the segmental review, looking at regional variations in M&A. As we typically observe, most deal flow is concentrated in North America and Europe. North American deal flow in 2017 was up 5%, probably a reflection of the strong regional economic outlook that was underpinning an increase in deal flow in the US. What was interesting to note is that average deal sizes in North America was a lot higher than in other regions across the globe. And that's probably a reflection of the US being a more mature M&A market for knowledge-intensive services, and therefore, this transition to focusing on larger deals is more apparent in the US as opposed to other markets across the globe. European deal flow was down 8%, and particularly there was a fall in UK M&A after the general election over summer. There was, however, a rise in European management consulting deal flow, and I would attribute that to probably a reflection of some of the demand for regulatory and strategic consulting advice, around issues like Brexit, which is increasing demand for those services in the region. Deal flow was down in APAC and Australia and New Zealand, but cross-border M&A is very strong in Asia, and cross-border M&A is structurally higher in Asia, and that's something that we do typically see. And it was clear in 2017 from deals like Cognizant's acquisition of Brilliant Service. WPP also acquired a business called ARBA. Generally, there is a lot of demand that we see from international buyers for making acquisitions in the region. to benefit from some of the economic development, and also to diversify out of local markets. And we have an excellent review of APAC M&A by Jean-Louis, our managing director in Asia, and you can find that on Equiteq Edge, and that gives a lot more detail on the specifics that buyers are looking for in the region, and also what to consider if you are selling a business in that market. Now, moving on to our review of valuation trends. Before we discuss the findings here, I did want to highlight the limitations of using reported aggregated valuation data to value your business. So a typical comment that I typically hear is, I saw an average valuation multiple of X in your report, and my company is generating Y revenue or EBITDA, and therefore I believe we should be valued at this amount. And that approach really is typically wrong. There's a lot of issues to take into account with respect to valuation. Issues around adjustments to profit that are not reported in metrics that you find on news articles or details in companies' accounts. There's also a lot of company and deal specific factors like growth margins, expected synergies from buyers that all influence the valuation of a business. And therefore, you really should treat the figures in our reports primarily as a comparative guide, and obtain professional advice if you want to gain an appropriate indicative value for your business. However, looking at the data on a comparative basis in our reports, it was clear, as we can see from the chart on this slide, that average reported valuation metrics were strong over the year, and they are a lot higher than they have been over the last few years. Probably an indicator of the strong market fundamentals, but that cash, the abundance of capital that's available in the market amongst buyers, and those limited opportunities in hot spaces of a market, all pushing up prices. Now, these dynamics are also impacting deal structure, which were on average more competitive in 2017 than the prior year. So again, a caveat for the data with respect to deal structures is that they do vary considerably from transaction to transaction, and we tried to show that in the bar at the bottom of this slide. And again, if you're looking to negotiate an appropriate deal structure for your specific sale, again, it's appropriate to gain professional advice for that. Using the aggregated averages in our report, wouldn't necessarily be appropriate. But looking at the average data on a comparative basis, we did see that deal structures were more competitive in 2017 as opposed to the prior year. The average percentage of consideration paid up front for a deal in 2017 was 61%, and that was a rise from 58% in 2016. And also buyers were negotiated to pay or to structure shorter earnout periods. So the average earnout period in 2017 was 2.6 years versus 3 years in 2016. And what we're observing is that in carefully negotiated sale processes for in-demand assets, buyers are typically willing to improve deal structures, normally before increasing valuation. So this is a deal feature which is important to carefully consider and negotiate during a sale process, ideally with professional advice. And in hot spaces of a market, we are seeing improving deal structures arising more last year as opposed to the prior year. Moving on to our review of buyers and who were the most active acquirers over 2017. We can have a look from this table that the top buyers over the year were really dominated by listed acquirers. What was interesting was that this year, Dentsu and WPP weren't the most acquisitive buyers across the knowledge economy. And in fact, on aggregate, the large media networks reduced their deal flow. They've been facing headwinds from falls in digital advertising spend from big clients like Unilever and Procter & Gamble. And as clients have been cutting costs, this has been impacting the big players. And what we're seeing is that some of the big accounts have been working directly with digital advertising platforms like Amazon, which is impacting players like the WPPs and Publicis. And on top of that, there is a new competitive threat that a lot of these big media agencies are facing. They're facing competition from business consultants and IT services firms. And one of these IT services firms that is particularly encroaching into the media agency space is Accenture. They moved into the space with a variety of acquisitions in 2017. That included the acquisition of Sinner Schrader, the Monkeys, and also Wirestone. Accenture Interactive, which is Accenture's digital arm, has been growing over the last few years through acquisitions like this, but also through organic growth. And according to some recent data from Bloomberg, it is believed now to be one of the largest advertising services providers globally. Accenture, like many of the other serial buyers on the list, are listed, quoted buyers. Their equity is quoted on a stock exchange, and many of these cases, their share prices have been rising, and also the cash balances that they have available for acquisitions have also been rising. And that's putting pressure on these buyers to put cash to work, with returns on M&A being particularly attractive in this low interest rate environment, and also enabling them to meet shareholder expectations for future growth as their share price rises. And as we can see here, share prices were robust over the year, and are now touching new 10-year highs despite a lot of political volatility that we saw over the year. The exceptions to this on a segmental basis was declines in the management consulting segment. Players like Huron and Navigant saw volatile share price performance over the year. And there was also declines in the media agency segment, which was impacted by weak performance from the leading media networks. And as we saw at the beginning of 2018, Martin Sorrell has now left WPP and recently announced that he's setting up his own communication services business. So some of those pressures on the big media networks still seem to be apparent as we're moving into 2018. In addition to listed buyers, accounting networks continue to be aggressively acquiring in the knowledge economy. And that includes the Big Four, and it also includes BDO, Grant Thornton, and smaller growing networks like Crowe Horwath and Wipfli in North America, all very relevant buyers for knowledge-intensive services businesses, particularly consulting and technology services firms. What we saw on aggregate is that the Big Four increased their deal flow over the year after making notable inroads in the consulting space already with deals like Booz and Monitor. They're now focusing on taking a larger share of the digital transformation market through acquiring creative agencies. Examples of that were Deloitte Digital's acquisition of Market Gravity, PwC's acquisition of Pond, all notable deals in the creative media space, and really creating another competitive threat from accounting networks for media players. Finally, with respect to buyers, private equity continued to be active in the knowledge economy, and we can see here that on average, private equity were involved in around 6% of all deals across the market, but their participation rises to over 12% for deals that are valued over $10 million in size. And that's likely to be driven by record levels of dry powder that are currently around in the market, and the search for larger investments to put that capital to use. Also, as more financial buyers are becoming comfortable with acquiring project-based, knowledge-intensive services businesses and completing successful exits in the space, they will target larger investments. And last year we did see a range of major deals that occurred in the market, and Duff and Phelps is probably a good example of a very profitable and successful exit for Carlyle, and a new high-profile private equity investor, Permira, now taking ownership of the business, demonstrating really the ability of financial buyers to make successful investments in this space. And that's really been followed up at the beginning of 2018 by deals like APAC's acquisition of Business Integration Partners. All putting a spotlight on the market with respect to very well-renowned and respected private equity firms making investments in this space. So finishing up, the outlook for M&A in the knowledge economy remains strong. There are a few long-term trends that we are monitoring over the next few years. So first of all, the evolution of digital disruption, how quickly new technologies like RPA, blockchain, augmented reality, how quickly are these going to be adopted by businesses? That will impact where we see the most M&A and the highest prices being paid over the next few years. Secondly, on a more macro perspective, we're now seeing the end of the low interest rate era. How that plays out in terms of M&A and particularly private equity-led deal flow, which typically relies on borrowing to boost equity returns, is something that we're going to be monitoring. And finally, in the US, we're watching the success of a new administration's infrastructure plans, plans for repatriation of cash and business-friendly regulatory reforms, and the expected economic stimulus that these could deliver. All of this could result in a further uptick in M&A within the region over the next few years. Now, one final comment as we wrap up. The rapid industry changes for traditional consulting and professional services firms that we talked about in the report and at the beginning of the webinar, really makes it an exciting time for someone in my position to be analyzing and reviewing such a transforming industry and marketplace. But it also creates a lot of opportunity for you as a business owner to grow within what we're calling the disruption zone of the knowledge economy, and realize potentially substantial value upon exit. So, this is a time of great opportunities and challenges for businesses out there. So with that, thanks for listening. Please reach out if you would like to discuss any of these findings in the context of your own business. And I'll hand back to Sophie for some Q&A.
Thanks, Ramone. So we've got a couple of questions. I'm aware we finished a bit early, so we're just going to do a few and we won't keep you for the full hour. Question one was about whether or not, with discussing an initial price for your business, should people be putting more emphasis on revenue or EBITDA multiples when thinking about that initial value?
Okay, thanks for that. That's I think that's a that's a good question, and it is, it is a question that we do get quite a bit from owners looking at how to approach valuing their business. So you know there is, but buyers will typically look at both metrics. Enterprise value as a multiple of revenue, enterprise value as a multiple of EBITDA. But ultimately, what businesses are purchasing is the residual adjusted sustainable EBITDA of your business. So that's going to be the focus of a buyer's investment analysis. So, I believe that the focus primarily is going to be on the EBITDA multiple that they're paying. But at the same time, there will be a triangulation of valuation with an appropriate revenue multiple based on comparable transactions in the market. So, I think buyer initially will try to get comfortable with an EBITDA multiple to value your business, but then they'll have a look at whether the revenue multiple that is coming out of the implied value for your business is looking sensible with respect to comparable transactions in the market. If it's not, if the revenue multiple looks well above what is out there in the market, then that will probably indicate that the margins of a business that are looking to value could be overinflated, and they might bring down the EBITDA multiple as a result of that to bring the revenue multiple more in line with what they're seeing in the market. So, I think typically, buyers are going to be looking at EBITDA multiples first, but they will be taking into account both metrics when valuing your business.
Okay, thanks, Ramone. The second question I think is quite interesting, actually. It's it's focused on engineering consulting they've mentioned, but I think it's valid anyway. If deal flow in the space, in your consulting space, is very weak, should you be holding off on selling your business?
Yeah. So, the engineering services segment was an area we didn't go into a lot of detail in this webinar, and that was partly because the deal flow in that segment of the knowledge economy was subdued, and it has been declining not just in 2017 but over the last few years. And I think there's a number of reasons for that. There's been obviously the low oil prices. In 2015 and 16, it has really impacted the industry. Last year, we saw a fall in infrastructure spending, which we believe impacted deal flow last year. And that overall has had an impact on deal flow in that space of a market. But I think one of the things that we did see in engineering specifically was that digital technologies, like building information modeling, there was a lot of demand for that. There was actually also a bit of an uptick in oil and gas M&A as oil prices started to stabilize last year. So there were pockets of a market where there was growth, and on top of that, even if you weren't in those spaces, and you have a strong business and you also have a strong strategic fit with a buyer out there in the market, you will still see demand for your business despite this overall lull in the space. So, if you're sale ready, you've got an appropriate buyer in mind, I wouldn't be turned off by, testing the market in its current state.
Okay, so we'll just do a couple more. I think this one's quite interesting. Is this person is IT consulting sector, but they've been approached by a private equity investor. And I think their question is, will private equity pay as much for their business as a competitor would do? Right, what would you advise?
Yeah. So that, the variations between, private equity and strategic buyers, when it comes to value is something that we do cover a lot in our research. And I think, just to clarify that, the view typically is that, with strategic buyers, they sometimes might be viewed as paying a higher price for a business because they'll be attributing a higher value for the potential revenue synergies that they can achieve from doing a strategic deal that a private equity, wouldn't be able to do on a platform or standalone basis. Um, Now, I think given the current market dynamics, that view isn't necessarily completely correct. There's a lot of capital available amongst private equity investors. Many of them have made strong returns in the space and have um, you know solid investment plans when they look at deals that they want to do in the industry. And as a result of that, they're able to aggressively price, and price at a level which is on par with strategic investors that are looking to make acquisitions in the market. Um, so, I think in this circumstance, to really understand, whether the private equity is going to pay as much as a competitor in your space, you really got to run a broad process. Consider testing the market with a set of private equity buyers, possibly competing strategics, and maybe even strategic buyers in adjacent segments of a market, and even a global set of buyers in other regions of the world. And that will give you the best idea on testing the market for who's going to pay the highest price, and also importantly to most owners, where's going to be the right home for you, and your business, as part of its next stage of evolution.
Thanks, Ramone. So I think we're going to do one more question. Because quite a few of our audience members are based in the UK today, I think we should be doing one around the UK. So this one's asked about, my business is based in the UK. Should I be waiting till after Brexit to consider a sale?
Yep. Yeah. So that's a good question. I think the potential impact of Brexit, um, you know, when it actually occurs on UK M&A, that's still really unknown. There was a lot of talk of a potential sharp slowdown in deal flow after the UK voted for Brexit in 2016, and that didn't really occur. What we found is that most buyers that we spoke with straight after the UK's vote for Brexit were really in wait and see mode, and I think that still holds true now. Most buyers that we speak with still haven't significantly slowed down their demand for UK assets. There still is a lot of strong demand for the right acquisitions in the region. So, I think if you've got a sale-ready business at the moment, there is appetite out there. I would take advantage of it. I don't think, waiting to see how the market fares after Brexit is necessarily the right approach. I think there is enough demand, buyer demand currently in the market that you can take advantage of.
Thanks, Ramone. So we're going to leave it there for today. I know we've had a couple more questions come in, but Ramone's going to come back to you personally on those. If you'd like to discuss any of the webinar or any plans about selling, or if you just have any questions about the process or anything, please do get in touch. Ramone's details are ramone.param@equiteq.com, or you can email myself, which is sophie.lewis@equiteq.com. Also, if you're not already a member, please do take a look at our website. We have a Equiteq Edge Club, which is free to join, but once you've logged in, you have access to all our reports, all our past reports, articles and blogs, and you'll also receive a monthly newsletter. Just want to say thanks to Ramone for your presentation, and thank you for everyone for attending today. We'll be sending around a recording as well within 24 hours, so you can re-listen if you'd like to. Thanks, everybody.